pay premium with their application. We'll see you on the next video. All right, so there is your conditional receipt. Hopefully that was helpful. Next, let's look at some disclosures at the point of sale. First, there are disclosure statements. Disclosure statements help applicants make more informed and educated decisions about their choice of insurance. Disclosure statement could be anything kind of like a buyer's guide that we're going to talk about in a minute. Next, there's a disclosure authorization notice, which states the insurer's practice regarding a collection and use of personal information. The insurer just needs to know that their personal information is being gathered, and then how can it be used, and just for underwriting purposes only. Next, HIV testing. Now, HIV testing, it's not against the law to do HIV testing. Usually for larger amounts of insurance is when an insurance company would do HIV testing. What you need to know for your test is who can have access to HIV test results. Well, if I'm the insured, I can, my doctor can, the insurance company can, and then the Department of Health and Human Services can. But I really want you to know who cannot have access, and that's why it's in your book, is anybody not involved in the underwriting process like other insurers. So other insurance companies cannot have access to HIV test results. Next, we have a buyer's guide. A buyer's guide is generic information. Explains how a buyer should go about choosing the amount and type of insurance to buy. A policy summary, which is going to be specific to a policy being issued. It will describe the features and elements of that policy. That could be anything like a brochure or possibly an illustration used in the sale of a permanent policy. Next, we have the USA Patriot Act and anti-money laundering. After September 11th, 2001, Congress passed the Patriot Act. All financial institutions are subject to the Patriot Act, and since insurance companies take in premiums, they are considered a financial institution. So usually for any transactions in excess of $5,000, if the insurance company feels that transaction may be for an unlawful purpose, like they're being used to launder that money in any way, they would have to file what's called a suspicious activity report